Today, we're diving into one of the most fascinating and polarizing companies in modern business, Tesla. From Elon Musk's audacious vision to record-breaking innovation, Tesla has redefined what it means to be an automaker in the 21st century. But while Tesla's story is compelling, the question we're here to explore is more nuanced. Is the stock price justified by the fundamentals, or is the market being carried away by hype and vision? Over the last decade, Tesla has transformed from a niche electric car startup into a global technology powerhouse. Its influence goes far beyond vehicles, extending into autonomous driving, AI, energy storage, and robotics. Elon Musk has repeatedly challenged industry norms, accelerated EV adoption worldwide, and created a brand that resonates deeply with both consumers and investors. World Emoji Lightbulb Emoji. Yet, as much as Tesla is a company worth celebrating, the stock market may be overestimating the likelihood of perfect execution across all its ambitious initiatives. From full self-driving, FSD software, to Optimus humanoid robots, and from energy storage to global expansion, the expectations baked into the stock price are extraordinarily high. In this presentation, we'll break down why Tesla is undeniably a great company, but why its valuation today may be irrational. We'll examine revenue trends, margin compression, FSD and robotics, energy storage growth, and finally, the overall investment takeaway. By the end, you'll have a clear picture of the risks and opportunities, the gap between company excellence and stock price reality. Let's start by looking at the fundamental disconnect between Tesla's greatness as a company and the extraordinary price the market is currently paying. Tesla is undeniably one of the most transformative companies of the 21st century. Under Elon Musk's leadership, Tesla has done what few companies in automotive history have done: combine bold vision with technological disruption and create a brand that is synonymous with the future of mobility. The Model S didn't just compete with luxury cars. It rewrote what customers expect from electric vehicles. Model 3 brought EVs to the masses, while the upcoming Cybertruck and Roadster continue to push design boundaries. And of course, there's the overarching narrative of Tesla as not just a car company, but a technology and AI powerhouse. From a strategic standpoint, Tesla is exceptional. It owns its supply chain to an extent rare in the auto industry, produces its own batteries in gigafactories, and has invested heavily in both vehicle software and autonomous systems. The company's brand equity is immense, and its loyal customer base ensures that Tesla products sell themselves in ways conventional advertising cannot replicate. It is, without a doubt, a great company. However, the question we must ask as investors is whether Tesla's market valuation matches its underlying fundamentals. As of now, the stock is trading at an EV/sales ratio above 15 times, and its forward price to earnings ratio is roughly 300 times. To put that in perspective, this is far above what even highly profitable tech companies like Apple or Microsoft have historically commanded. Essentially, the market is pricing in a scenario where Tesla executes flawlessly across all business lines for the next decade. While Tesla continues to generate headlines and excitement, we cannot ignore that the stock price reflects expectations that are extraordinarily high. Investors have embraced the vision so enthusiastically that any minor operational hiccup, regulatory delay, or competitive pressure could lead to outsized volatility. A great company does not automatically equal a sound investment, especially when the current price assumes perfection. In short, Slide 1 sets the stage. Tesla is a visionary, industry-changing company, but from an investment perspective, the price is already accounting for nearly everything positive the company could achieve. There is little margin for error, and this creates substantial risk for those considering entering the stock at current levels. Great company, yes. Rational valuation? That's another question entirely. Tesla's growth trajectory over the past decade has been nothing short of extraordinary. Revenue has doubled since 2020, production volumes have scaled impressively, and Tesla has become a global household name. Yet, when we look closer at profitability and operating margins, we see a different story. Despite revenue growth, Tesla's operating margins have compressed significantly, declining from roughly 16 to 17% to just around 6% in recent quarters. Free cash flow, which once reached record highs, has also diminished from its peak levels, signaling that operational efficiency has been challenged by either rising costs or investment requirements. This disconnect between top-line growth and profitability is crucial to understand. Revenue growth alone cannot justify a valuation that assumes perfection. While Tesla's brand and technology are undeniably valuable, the company's margins suggest that scaling operations, launching new vehicles, and maintaining software and battery production simultaneously is expensive and increasingly complex. This is especially true when considering the need to continue innovating in autonomous driving, energy storage, and robotics. A few more concrete numbers help illustrate the point. In 2024, Tesla posted record revenue, yet net profit was essentially unchanged from 2022. What does this tell us? It tells us that the revenue growth is not translating into proportionate profit growth. Expansion is expensive, margins are shrinking, and investors who are counting on a linear extrapolation of revenue into massive profits are likely overestimating potential returns. In addition, Tesla's slowing growth is compounded by intensifying competition. Traditional automakers such as Volkswagen, BMW, and Mercedes are investing heavily in EVs, while new entrants like BYD, NIO, and XPENG are rapidly expanding in China and Europe. This competitive pressure could further compress margins, slow Tesla's revenue growth, and challenge the market's high expectations. In short, Slide 2 highlights a core concern for investors. Growth remains impressive, but margins are compressing. Free cash flow is declining, and revenue gains are not translating to proportional profit increases. The extreme valuation assigned to Tesla assumes continued rapid growth with high margins, a scenario that, based on current trends, appears increasingly optimistic and risky. A major part of Tesla's long-term narrative lies in autonomous driving and robotics. Full self-driving, or FSD, has been in development for nearly a decade. The technology is impressive. The company's neural network, real-world data collection, and software updates are industry-leading. But the commercial rollout remains limited due to regulatory, legal, and hardware challenges. Even after years of beta testing, FSD is far from a mass-market product. Similarly, Tesla's Optimus humanoid robot has captured the imagination of investors and tech enthusiasts alike. Demonstrations have shown promise, but at this stage, Optimus is largely a prototype. Production-ready, revenue-generating robots are likely years away. The critical point for investors is that the market has largely priced in partial success from both FSD and robotics. Tesla's current valuation assumes these initiatives will eventually scale, become profitable, and contribute meaningfully to revenue. This means that much of the future upside is already baked into the stock price. Any delay, misstep, or failure to meet lofty expectations could trigger a sharp market correction. Regulatory hurdles in autonomous driving, supply chain constraints, or slower than expected adoption rates could all materially impact Tesla's stock. Slide 3 emphasizes that while FSD and Optimus are exciting and technologically advanced, investors need to recognize that these futures are largely anticipated. The risk isn't whether these projects are innovative, it's that the market has already priced in their success, leaving little room for error or unexpected delays. Tesla's energy business, which includes Megapack and Powerwall installations, is increasingly important for its long-term diversification. Energy storage is projected to be a multi-billion-dollar market, driven by the global transition to renewable energy and grid decentralization. Tesla is well-positioned, with technology and manufacturing experience that few competitors can match. However, there are several challenges. First, scaling energy storage requires significant capital investment. Building facilities, securing battery supply, and deploying products across diverse markets is expensive. Second, Although installations are increasing, energy revenue currently represents only about 10% of Tesla's total sales. While growth is impressive, this segment alone cannot justify the stock's extreme valuation. Another important point is timing. The market has already assumed near-perfect execution for Tesla's energy business. Analysts expect the company to dominate the grid storage market and maintain high margins. This is a best-case scenario, and any delays, supply constraints, or competitive pressures could lead to valuation compression. Slide 4 highlights that while energy storage provides Tesla with a promising long-term opportunity, it is not sufficient to support the current valuation on its own. Investors need to distinguish between technological potential and financial reality. Success is not guaranteed, and the market has likely overestimated the immediate impact of energy storage growth. Finally, let's consider valuation and the investment takeaway. Tesla is unquestionably an outstanding company. Its innovation, brand, and technological leadership are unparalleled in the automotive and tech sectors. But as investors, we must focus on the relationship between price and risk. At current levels, Tesla's stock assumes near-perfect execution across multiple ambitious business lines: vehicles, FSD, robotics, and energy storage. The margin for error is almost non-existent. Any operational hiccup, regulatory setback, or market shift could trigger sharp valuation declines. Historically, stocks priced for perfection experience significant downside when reality deviates from expectations. Analysts are increasingly labeling Tesla as overvalued. While it remains a market leader, the stock does not offer a margin of safety. Valuation multiples are likely to compress over time, particularly if growth slows or margins fail to meet expectations. For risk-conscious investors, there are alternative investment opportunities with more favorable risk-reward profiles. Companies in healthcare, consumer products, or technology may offer strong growth without pricing in perfection. Slide 5 underscores the core message of this presentation. Tesla is an extraordinary company, but the current stock price is irrational relative to fundamentals. Understanding the difference between company quality and investment value is crucial. Tesla may continue to innovate and lead in its sectors, but the stock is priced for perfection, and perfection is rare in business. Investors should exercise caution and prioritize risk management over hype.